Hello, everyone. My name is Robin Dolezal. Today is Thursday, December 15th. With me, as always, is Dan Nentel and Alex Pars. Together, we are with Ironwood Financial. Good morning, gentlemen.
Morning.
Morning.
Well, let's get started with obviously the horrendousness that we've all been seeing this morning, and that is of Alex's sweater. That is just awful. Where did
Talking about this is very seasonal, right?
Yes. Dinosaurs.
T-Rex.
we had how long has it been? We did a client event. I don't know. Was it 4 or 5 years ago? We did ugly sweaters.
It's
Yeah.
probably been more like 7 or 8, I would guess.
Has it been that long?
Yeah.
That was a good one. Well, thanks for bringing that back, Alex. I love it. All right. Well, let's get started, Dan. Before I get you into the market, I just want to bring up some numbers year to date. I mean, we're almost to the end of the year. Have you guys seen the 20-year Treasury, though? This is awful. They're still having a terrible year. We're down about 23.5 on 20-year Treasuries. Our aggregate bond funds, not ours, I should say, AGG is a good indicator for this. This is just the aggregate bonds in general, still down about 12% year to date. And as of now, as of this morning, the market's down after obviously what the Fed has talked about. The S&P is down about 19%. Dan, give me your thoughts on what's going on in the market.
Well, unfortunately, the last few conversations have been about direction the Fed is going to take us and how quickly they're going to slow down the economy, and if there's a crash landing or a soft landing, and when are they going to stop, et cetera. And reality is, yesterday, Chairman Powell said exactly what he told us he was going to say, which we've been pretty consistent on, that he tells us what he's going to say, he does it, and then he tells us what he did. Most people are saying, had he done that and just kind of ended the meeting right there and not gone on about how we need to stop paying. And I know Alex is going to talk about this, but the tone of his conversation made the market feel a little bit negative. And then the ECB, the Europe banks, they raised interest rates this morning. Bank of London raised interest rates last night. And so everyone's thinking, well, my goodness, we just can't stop this inflation, which is the core of why the Fed's doing what they're doing. But reality is nothing changed, right? I mean, realized 6 weeks ago, they said they were going to do 75 basis points. Yesterday, I was talking to a friend of mine, and I was trying to get an analogy of when I have a broken window, like when's this window going to show up? And he goes, there's a lot of different moving parts. And he goes, imagine this. Imagine the Fed said they were going to raise interest rates 75 basis points, but they only did 50. And I'm like, wow, everyone's talking about this guy who's a person who sells windows. So all anyone's talking about right now is what the Fed's going to do. Most of the things I've been reading about is right now, because it's uncertain as to when the Fed's going to end. And again, Alex will address that more. Right now, it seems as though we've got the big banks kind of looking at what they call support and resistance. And right now, based on technical analysis, which many people don't believe in and hasn't proven to work very often, including what Alex thinks, right now at about 4,050 in the S&P, you're seeing people sell out of the market. And then they kind of hold off until the S&P gets back down to, say, 3,600 or something like that. So they're playing at about a 450-point window. And as a friend of mine who's with another big bank, he said, you can play that and try to time it, but you have to be right twice. And if you're wrong just one of those two times, you're going to miss out on a whole bunch of upside momentum. So right now you're seeing the market maybe get played with a little bit. The big banks, when you look at Goldman, JP, et cetera, they still have a target for around 4,150 to 4,200 by the end of the year, just in the next 15 days. Mm-hmm. So really nothing's changed. Yeah, we're frustrated the Fed maybe was a little bit more demonstrative than normal, but PEs are still good. If you look at what's going on in the bond market, I looked yesterday, you could get about 4.3 on a 3-month Treasury. Right now it's up to 4.4. A 2023 bond, if you want to do an index, can get you about, almost 5, and that's super high quality. If you want to go lower quality, you can get near 8% on a 2024 bond. So again, a lot of noise, but nothing really changed.
Yeah. It's always interesting, the market reacts to what the Fed does, but then it's like a whole nother reaction once he actually gets and does his press conference.
Oh, well, think about it this way. And again, not to take anything away from what you're going to talk about, Alex, but so he spoke. And if you look at the trend, the week before he speaks, and we were kind of optimistic this week, but after he speaks, the market gets all panicked. Then it's almost like they forget completely about it because, again, we're not going to have a rate increase again till February 1st-ish. So we're going to forget about it, and we'll probably see another one of these rallies until they get ready to speak again.
Yeah.
You
So
know,
Alex, the Fed finally reduced its rate increase from 0.75 to 0.5. What are your thoughts? Why did the market react the way it did?
so what the market was, as we talked about, hoping to hear was, yes, inflation is done. We're done fighting this fight. Go on about your merry way. And of course, he can't say that. Again, if he says that, what's the market going to do? It'd be up probably 10% or something like that. We still have over 10 million jobs available. You put those two pieces together and boom, you've got inflation coming right back. So regardless of what he thinks, it's kind of like a politician when you ask them, are you doing a good job? Right? What are they going to say? They're not going to say, well, I could do better. Like, absolutely, I'm doing a great job. There could be no possible room for improvement. Right? I mean, he's got to say, we are going to nip this in the bud. And that's what he keeps saying each and every meeting is we're going to get inflation back to our 2% target. We are unwavering in our determination to do that. And, what he said yesterday was basically that once again. And then they said, okay, well, we're changing our, end point reading from maybe 5-ish to 5.1. At least that's the consensus. So
Yeah.
not a significant move, seeing as we're sitting around 4.25 to 4.5 now. So we were hoping for 1 to 2 rate hikes of a quarter point next year. Now we're hoping for 3. We're kind of expecting 3. But what he always says every meeting, you get all these reporters asking him, what are you going to do next time? And what does he say every time? We don't know. We will tell you when we decide next time in 6 weeks. And so for us to say, oh my gosh, he just told us he's going to do 3 more rate hikes in the next year. Well, he's not told us and he's not committing to what he's doing next meeting, let alone next year.
Yeah.
Okay. And I do like to point out that this is forecast, consensus forecast. Remember what his forecast was back in January through March of this year. Inflation is transitory. This is not a problem. It's going to go away. We can kind of ignore it. Well, now his forecast is maybe 0.75 of a point. Again, that's what we've seen in one meeting, and he's talking about that over the next course of a year. So not, what we were hoping to hear, not what the market was hoping to hear, but it's not like it's terrible news. This is still the pivot point that we've been waiting for. It's still the point where we say, okay, things are going to slow down, see what happens, and hopefully we're going to see fewer rate hikes, less time at a high elevated rates. They still expect rates to go down in 2024 and continue to fall in 2025. So
what was the data that recently came out? Obviously, what was it, Tuesday or Wednesday this week that they were waiting to see before they made this announcement?
Inflation data. So the inflation data for October was good. I think at a 0.2 or 0.3 for core inflation, depending on which metric you follow. And again, if you multiply that times 12, you get about 2.5%, which is not far from their stated target. The numbers that came in on Tuesday were similar. We're looking at 0.2 on core inflation, again 2.4 annualized. So 2 months in a row, we've actually got the data we wanted. But again, they can't say that. They can't say it's over until it's well and truly behind us. Otherwise, things will just get bad again.
Right.
Alex, what about we've been hearing over and over 2023 is the year of the bond. And I've kind of assumed the reason they were saying that is, as interest rates go up, the value of bonds go down, or you can actually start getting better yield if you're new to purchase. And it seemed like people are thinking to themselves, historically, when you raise interest rates, you wait 2 quarters to see how it panned out. And we're not doing that because we're so panicked on how heavy inflation's been. I kind of assumed that people were assuming that we're going to have a somewhat of a crash landing or a bumpy landing, and the Fed would pivot completely from raising interest rates to actually lowering them, meaning that the bond prices not only are paying good yield, but we're actually getting a bump in performance. Is that still something that's out there for 2023 or?
Well, and that's what people were hoping, is that mid-2023, I've heard people saying, oh yeah, by April, they're going to start lowering rates. This will be over soon. That's just pure optimism. The Fed has not said that. Again, they don't know what they're going to do. What they've said is they expect rates to be up next year and down in 2024. And yesterday's meeting, they said the same thing. So, while bond yields are good, and I don't expect bond prices to get walloped like they did this year, it's kind of a, if you were to go out and buy a bond for 3 years now, and let's say it's paying 8%. And again, that's a very attractive rate, the best we've seen basically in 20 years. So if you were to do that and interest rates go up, your bond is going to depreciate a little bit, but it's still going to pay you that 8%. Yes, if you'd waited, you could have gotten 8.5, but 8's pretty good. So next year is going to be a good year to hold bonds. If the market rallies, we do anticipate getting more into bonds. But in terms of seeing bond prices increase, I'm honestly hoping that we don't see that, because we'd like to have the opportunity to make our bond ladders longer.
Gotcha.
When do you want to buy, high yielding bonds? You want to buy them when rates are high. And how long do you want to buy them for? A long time, if you think that rates are going to go down. So hopefully next quarter, maybe the quarter after that, we've got to peak at interest rate. And at that point, yes, we want to go longer bonds. And then hopefully rates go down and those bonds appreciate, which makes our statements look good and everyone feel warm and fuzzy.
Yeah. Well, let's end on a good note. So I know you look at the ladder, the bond ladder, frequently. As of now or yesterday, whatever it was, on we'll call it a 4-year term, from 2023 to 2027 now. What's our average yield?
I mean, if you're mixing high yielding corporates, I mean, you're talking 6.5. It hasn't really changed since yesterday.
Right.
So not a big change.
I think that's an important point and a little bit of outlook for us, and that is, we do anticipate the Fed to stop tightening. Whether or not they over tighten and we actually see some rate decreases, that's anyone's guess. But when that happens, we will see a market rally. And one of the things that we haven't seen literally since the tech crash of '99 is for us to actually have the opportunity to get rid of there is no alternative and try to be heavy equities, and actually add many more bonds to our portfolio and make people more conservative as a hedge against the volatile market we've been seeing. So the great pivot, as I keep saying this year, actually, this could work out, especially for those people about to retire or are retired.
Yeah, it's a great time for new money. I mean, you can go out and buy bonds at 6.5%. You can buy stocks at, mid caps, small caps, 12, 13 times PE. That's some of the best numbers we've seen in years.
Yeah, those values are tremendous. So, I mean, we've got 2 weeks left. Are we waiting on any other information, or is that the only information that we've got really coming out?
There's going to be, inflation information or inflation jobs, et cetera, but really nothing probably terribly interesting again until next year.
Yeah.
It's again all about the Fed. What's the Fed do? We want to see the numbers continue to show a softening economy. Again, the economy is ridiculously overheated, or it was. We want it to get less overheated. That doesn't mean a crash, but again, 10.5 million jobs. We want to see that number around 7. Still too many.
So not to extend this, because people are probably getting bored, but you keep hearing about credit card debt. People are running out of savings, and you're starting to see credit card debt. The trend is going up, and now that they are looking at the interest rate they're paying, they're getting some kind of statement shock, if you will, on the interest that they're paying on their credit card debt. Today we saw that retail sales were down. That's the bad news that actually is good for the market, isn't it? Or is there something I'm missing?
Well, first off, back in Q3 of last year, credit card debt basically hit an all-time low in terms of delinquencies at about 1.5%. Okay, and we have since gone up to 2.1. Okay, so to put that in perspective, so that's that's a 30 some odd % increase in only a few months. Well, to put that in perspective, pre-pandemic it was 2.6. So we're still below the pre-pandemic default rates. And again, if we're looking back at our 2009 numbers, we're looking at about 7. So this is still basically, except for a couple months ago, we would be saying this is a historic low for credit card delinquency. You got to take these numbers with a grain of salt, because yes, like days on market or for housing price homes, they've doubled, okay, from like 1 to 2, right?
Gotcha.
It's worse than that, but you have to remember the absolute number along with the percentage, because what's going on is coming off of all-time lows for a lot of stuff. But yes, retail sales being down, that's what we want to see. We want to see everything slow. Okay, we don't want to see a crash. We want to see it slow, and it's going to take some of that. As Powell said yesterday, he wishes he could get there without some pain, but he doesn't know a way to do that. So there will be some pain. But again, we would expect a pinch, not a, fist in the face.
Right. Well, I will commit this to you guys that I will increase my consumer spending this month to help edge that up, and I will start with getting Alex a decent sweater.
What?
All right, well, folks, that's where we'll leave you. If you have any questions that we didn't address, please don't hesitate to reach out to us. You can find us at ironwoodfinancial.com, or you can reach us toll free at 888-271-4646. If we don't talk to you, I mean, we've got a couple more weeks, but have a great holiday, folks, and a happy new year. Thanks, guys.
By the
Take
way,
care.
one last thing.
Yeah.
I'm hoping, not official, hoping to head to Minnesota here in this next week, and they've got about 2 feet of snow last night, but the day that I arrived, it's supposed to be -1 degrees. So
Ooh, nice.
Very
So
nice.
I need to get you a sweater too.
thanks, buddy.
You can borrow mine.
There you go.